Yo, what's up? Another video. I got hot off the presses. We're going to be talking a little bit about the rising bond yield. I know, the most exciting subject ever. It's going to be a quick video today because I got to go and take care of some stuff. But I just wanted to say that, yeah, economy's, market's still, going a little bit downish and sideways. Of course, a crazy recovery is expected in the next few months, right? Due to the vaccine plans and the stimulus that's coming in to stimulate people buying and the economy return, the consumer economy returning, and yada yada. People just tired of like not having money and jobs, and the jobs report, being initially and generally uh, underwhelming, should actually be more positive moving forward. Also, March is typically uh, a higher grossing month. The market usually increases in March, and I think in March, March is considered usually on average the fourth highest grossing month for the market, and I believe the number was like 1.1% of growth on average. I think March. I mean, obviously last year was a problem, right? But this year it's March Madness is expected to kick in for stocks, and earnings season is about to end. So we'll see. We're coming to a bifurcation point, the 160-year point. We'll see. How well March. It's how well projections for March are planned to be, or how well projections plan March to go. So let's just like do a little bit of gathering on tech because a lot of the a lot of the questions we've been dealing with right now are around uh, big tech, suffering, the FANGs suffering due to tech fatigue, big tech stock fatigue, and then the, you know, rotation income kind of coming into play, and people uh, looking, or the rotation sectors coming into play, and people looking into distressed stocks and GameStop and things like that. Companies like GameStop, although GameStop's a bit of an outlier for several reasons. So, and really, a lot of what's going on, it's being reflected in the bond prices. So the 10-year Treasury yield moved up, and it's been moving up and up and up. And Powell, Fed Secretary, has been trying to keep it down, right? Because like as the bond yield goes higher and higher, bond traders, uh, put more money into bonds and whatnot because the yield keeps going higher. The Fed, that indicates that the stocks would suffer, stock market would suffer, and eventually and essentially let the Fed's if the Fed rate has been low for a long time, right? The Fed rate has been what 0.2%, or I don't not even know 0.2%. It's been like negative interest rates essentially, and it's been pretty flat. And people are kind of afraid of perhaps unfounded inflation fears causing the market to rise, causing inflation to rise, and the Fed having to increase interest rates to combat that. Increasing interest rates would obviously put a damper on the economy, and we don't want to do that because the economy is getting out of a rut. At least that's the expectation. So tech, big tech, the high growth, the high value tech, really they're consumer driven, and they suffer, when bond yields rise because people have less money, and people are essentially there's less economic activity that is spurring a big tech to move forward. Um, what's interesting though is that, well, let's hear what Mr. Goldman Sachs has to say about this. Like obviously take everything Goldman Sachs says with a grain of salt. They're still political, but it's just worth listening to.
Brooke Dane is co-portfolio manager of the Technology Opportunities Fund at Goldman Sachs, which is up 45% in 2020. He sees the tech pullback as a buying opportunity. Brooke, welcome.
Well, a tech pullback is a buying opportunity, right? Because honestly, tech is not going anywhere. This was the aberration black swan event, which caused tech first of all to increase to overheated levels, right? Like Netflix and all those companies, everybody, Tesla, they all increased to really high overheated levels, and they increased in the midst of a pandemic, and now we're just getting some of that money going back into other places, but overall, if you project long term into the future, regardless of rising bond yields, anything else, big tech is always going to move forward because historically, they're the powers that be essentially, right? And also, um, historically being, at least within 10 years ago. And generally that technology is going to keep increasing, right?
I suppose you don't think that rising rates are a problem, although we have seen rates steadily rise since the beginning of this year, and we've seen all of those big cap tech stocks that I named in the intro, while they're off just single digit percentages this week, they are down double digit percentages from their highs this year. So how do you interpret just the price action? The price action is telling us that it is a problem for technology to have rates go higher.
Yeah, thanks, Melissa, and great to be on the show. So, our central belief is that, we're at the front end of this massive wave of tech innovation.
So basically, right, price action is a technical in this case, right? So price action is reacting to higher bond yields, but, price action doesn't give the entire gist of the projection and should not be the entire gist of the projection for the company moving forward. But let's continue.
And that we think that there's incredible opportunities in the sector. And while rates have moved up, and that does impact long-term values of the stocks, what we're seeing is that these stocks have actually discounted much more of a rising rate than we've seen and we're likely to see. What we've been talking to our clients about is a couple key things. So first of all, we think that there's a huge opportunity in that next level down of companies below the mega cap names, both in the U.S. and more importantly globally in the tech.
That's important, right? Because everyone thinks of big tech as FANG, right? People should start thinking about mini FANG, whatever that is. I'm not sure at this point what index indicates it. If you do know, leave it in the comments. I'm sure it's one of the sub Nasdaq based indices, or maybe there's a ETF which collects mini FANGs, right? Is a portfolio of mini FANGs. Whatever the case is, startups, things like that, those are going to that are innovating are going to start really seeing a lot of the rotational money funneled back into them. Perhaps a lot from big tech, right?
Sector where you can get real opportunities on the next generation platform companies that are rising. Secondly, we really think that you want to be balanced. You want to have a portfolio that's built with some of the big disruptive, fast-growing, companies that are changing the world, but you also want to have some of the more compounding companies in there that are steady growers and that are, compounding at high rates of return. So, we're always talking balance. We're always talking about moving.
I mean, he's basically talking about essentially, market cap-based dollar cost averaging in the tech market, right? Like he's not putting all his eggs in one basket. He's not putting all his eggs in the biggest basket. He's saying that maybe it's best to put your eggs in the values, the sub high growth stocks, and also keep some of that in the high growth stocks because you know that Facebook's going to survive, right?
Incrementally into these things. But as we sit here, right now, with the pullback we've had over the last week, we think there's real opportunities to put capital to work in some of these high growth names specifically and some other areas as well.
So the high growth names that are sort of the next level down, not the biggest of the big cap technology stocks, Brooke, how should we think about them in terms of valuation? Because what seems to be emerging in the tech space, at least amidst this rising rate environment, is a bifurcation in terms of the highest valuation stocks, which are hit much harder, versus the lower valuation, quote unquote, value technology.
Please show some graphs, all right? Okay, when you're talking, you see, I would love that this segment would show some of an index that would really indicate these sub-massive growth, high value, but not super high value stocks, then the price of that index increasing, and the constituents of that index. It would be nice, just a nice contrast, right?
These stocks, which have weathered it a lot better, and I'm thinking in terms of high valuation, the IGV software ETF, for instance,
there's an ETF, the IGV software ETF. Let's take a look at that. Okay, IGV software ETF. I think that iShares expanded software sector ETF, right? And overall, there's a sort of a logarithmic type curve here, but there's a little bit of a beating that's been going on the last few days, right? You have a pretty large down candle, and I mean, like we just want to. Whoa. Okay. Yeah, I mean, and I guess the components of that stock are important. Some of those probably include, we can look up IGV components, but these are basically the big tech stocks. That he's talking about the IGV components suffering more than the Nasdaq suffered. And if you look at the Nasdaq today, there's a huge down candle in the plus 0.9272. That's overall. But I guess you see this huge down candle, which is kind of, I think coming, right? And we'll just have to have a recovery from this large down candle in the next few days. NASDAQ. We just have to assume that there's going to be an increase, that this is going to be corrected for. And look, overall, you can see, yes, overall, this is the overheating of the tech stocks, right? So at some point, the NASDAQ has got to balance out, and people have got to take money. Well, someone's got to take money. Who keeps adding all this money in there, right?
Hit much harder this week than the overall NASDAQ.
Yeah, so, software is one of the real innovation engines out there in the global economy. And we are seeing a whole new generation of companies come up that we think can be very large companies over time. We do think this is a huge role for active stock pickers to come in and differentiate between, what are the likely champions over the coming decade versus what are going to be on the wrong side of that disruption. But with that said, you've seen kind of average price to sales multiples come in by 3 or 4 turns across the growth software universe. And while price to sales is only kind of one metric of valuation, it's a decent shorthand thing for looking at, what's the market pricing these things at. We think there's a lot of these companies that can grow, sustainably in the high 20s for many years to come. And that at these kind of price levels, it's starting to get in the zone where we're interested in adding positions. So,
Okay, so it's starting to get in the zone. I'm sure they've been interested in adding positions for a long time. Anyway, let's just take a look at the fundamentals. I think it always pays to look at the treasuries now. That's what I'm going to be doing, and you can tell 10 years treasuries are going up again. So this is what people are talking about. That this was quite a rapid increase. Quite a rapid increase, right? This is since the beginning of the 10-year treasuries. But if you go to the 6-month, right, like look at this. Just they just keep going up and up and up. Year to date, that would be since 2021 started, and that's crazy, right? Like, I mean, typically that indicates action on the stock market in terms of fear, right? And that this motivated Jerome Powell to act. So, we should keep an eye on these from now on. So I'm gonna talk less now. I'm gonna cap it a little bit, but thanks for watching, and I'll see you tomorrow on the flip side of the upside. See you later. Oh, like and subscribe. And also, none of this is investment advice. This is just my observations of the market, and I like seeing through the lens of the occlusion. Right? We want to know what's happening. We want to know the reality of the situation, and that's all that is. I'm not necessarily investing based on this, and I don't recommend you invest based on what I say. Invest based on what an certified investment professional says. Okay, there you go. CYA done. See you later.